Howdy, everybody. Welcome to Liberty Call. Today is Friday, May 9th, 2025. Hope you're having a fantastical day out there in the interwebs. It is a gorgeous day here in Colorado. Sun's out, a little cloudy, but weather is nice. So hopefully it's going to be a good weekend. And for everyone out there, hope you're going to have a good weekend too. So markets coasted into the weekend, cooling off after Thursday's rally. The Dow, S&P, and NASDAQ all slipped slightly as investors watched for movement on Trump's proposal to dial China tariffs down from 145% to 80%. Pinterest popped 14% on strong user growth, while Expedia sank on soft travel data. All eyes now turn to next week's inflation and retail data. So before we get into the news and all the data and all the stuff we're going to cover on than we normally do on Fridays, I need some help from you. If you could give me some thumbs up, a like, share, subscribe, and follow, and press that notification bell. All righty, well, let's hop into today's markets. Dow Jones, Dow Jones finished the day down 0.3%, 125 points, closed at 41,243. S&P 500 down 0.09%, 5 points, closed at 56,58. NASDAQ flat at zero, up 0.78 points, closed at 17,928. The VIX fell 2.49% today. It's at 2192. Canada up 0.41, Brazil up 0.21, and Mexico down 0.52%. Headed to Europe, Germany up 0.59, the UK up 0.27, France up 0.64, the Netherlands up 0.43, Spain up 0.48, Italy up 1.02%, Switzerland up 0.02, and Portugal down 0.52%. Russian exchanges both the same today. The MOEX and RTSI are both up 0.63%. And the overnight markets, the Nikkei in Japan was up 1.56, Australia up 0.48, New Zealand up 1.93. Got some red in China. The Shanghai was down 0.3, Shenzhen Component down 0.69, China A50 up 0.42, DJ Shanghai down 0.44, Hang Seng up 0.4, and the Taiwan weighted when it closed on the 8th was down 0.01. All right. Sorry, I'm a little froggy today. Just allergies are creeping in. It is springtime in the mountains, so this does happen. All right, well, let's get to the let's look and see how the markets did for the week while my doggies. Hey, you too. Stop. All right, well, let's go ahead and see how the markets did for the week. Starting out with the Dow Jones, looks like it's going to be pretty flat. It's going to be down about 0.16%. The S&P 500 is going to finish the day or the week down 0.47. The NASDAQ is going to finish the week in the red, down 0.3. The Dow Transports is going to finish the week down 0.22. And the Dow Utilities, there it is. A slight gain of 0.14%. So it looks like the rest of the markets were pretty much flat for the week, so not totally surprising. So having dog wars back here behind me, they're starting to get along. I mean, it's only been a week together, so for the two of them, but the big dog is not a fan of the little dog because the little dog likes to annoy the big dog. So, all right, well, let's jump to the economic data for the week. Initial jobless claims came in at 228,000, below the 231 forecast and below last week's number of 241. Continuing claims came in at 1.879 million, forecast 1.89 million. Hey. And the previous number was 1.908. The ISM non-manufacturing prices index came in at 65.1, forecast was 61.2, so pretty good there. The U.S. S&P Global Composite Purchasing Managers Index PMI came in at 50.6. Forecast was 51.2. Previous number 53.5. The U.S. trade balance came in at 140.5 billion in the red. Forecast was 136, so worse than forecast. Previous week or previous month's number was 123.2. The Fed interest rate decision, they didn't do anything, stayed at 4.25 to 4.5. So you can see that we've been in the same spot for a number of months. Consumer credit came in at 10.17 billion. Forecast was 9.8, and previous number was a contraction of 0.61. So back to kind of where we were in the previous months, jumped back after a contraction last month. U.S. non-farm productivity quarter over quarter contracted at 0.8%. Forecast was a contraction of 0.4. Previous was 1.7% growth. Unit labor cost quarter over quarter grew by 5.7%. Forecast was 5.3. Previous number was a 2. Wholesale inventories month over month grew at 0.4%. The forecast was 0.5. Previous number was a 0.5. And last but not least, the balance sheet came in at for the Federal Reserve at 6.711 billion. Is that billion or trillion? Yeah, I don't know. And previous number was 6709, so it did go up just a hair over the last month. All right. So that is all of that. Let's get to the market recap and see what happened today. SP 500 edges lower as Fed speak. Upcoming China trade talks stoke caution. All right. U.S. stocks edged lower Friday as investors traded cautiously ahead of the weekend's scheduled U.S.-China trade talks. Market sentiment was rattled after President Trump hinted at an 80% tariff on Chinese goods via social media, stating 80% tariff on China seems right, up to Scott B, in quote, referencing Treasury Secretary Scott Bessent. The post fueled speculation about whether this rate would represent a compromise or a reduction from its current 145% rate, though still seen as protectionist by markets. Analysts at ING emphasized that only a meaningful de-escalation with China could significantly alleviate the economic drag of ongoing tariffs. In monetary policy, Fed officials delivered mixed signals. Atlanta Fed President Raphael Bostic warned that U.S. Economic reliance is weakening compared to earlier expectations. In contrast, Fed Governor Adriana Kugler suggested that the economy remains strong enough for the Fed to remain patient before initiating rate cuts, casting doubt on market expectations of 3 to 4 cuts this year. On the corporate front, chipmaker NVIDIA plans to release a less powerful version of its H20 AI chip in China to comply with U.S. export restrictions. According to a Reuters report, quarterly earnings wrapped up with mixed results. Affirm Holdings fell 13% after issuing a disappointing full-year outlook, despite beating Q3 estimates. Expedia dropped over 7% due to weaker than expected U.S. travel demand. Conversely, Pinterest jumped 5% after issuing strong forward guidance, helping to ease concerns about advertising headwinds and amid global economic uncertainty. Overall, tariff anxieties, Fed uncertainty, and mixed corporate earnings kept markets subdued heading into this weekend. All right, so that's some awesome news. Let's check in on the China negotiations. This comes from Zero Hedge. Fear of an economic collapse forced China to negotiate with Trump. Quietly reach out first, Reuters report. So are the Chinese the ones who were pushing for this? China's economy is under intense pressure from President Trump's escalating trade war, and behind its nationalistic rhetoric, Beijing is quietly preparing to concede ground. Despite public defiance, such a posting Korean war footage and denouncing U.S. tariffs as bullying, Reuters reveals Chinese officials are increasingly alarmed by the economic toll. Major Chinese sectors, including textiles and manufacturing, are suffering factory shutdowns and layoffs. Job losses may exceed 16 million, with China's central bank already injecting fresh stimulus. And I did the numbers on this. 16 million of the billion and a half population, that comes out to like somewhere under like 5% of the total population, assuming they all work. All right, Trump tariffs, originally framed at around fentanyl enforcement, hit hard, while China's public messaging denounced the tariffs and claimed steadfast resistance. Reuters confirms Beijing reached out quietly in April for negotiations, rebuffed initially due to insufficient seniority of the envoy. Now, high-level talks are set for Geneva with Vice Premier He Lifeng and top public security official Wang Xiaohong leading China's delegation, the later signaling fentanyl is central to U.S. demands. Trump hinted at easing tariffs slightly down to 80%, but Beijing fears being seen as capitulating. China's diplomatic efforts are two-faced, domestically projecting strength while privately seeking compromise. Officials are especially concerned about being left out as other countries negotiate separate trade deals with Washington. Additionally, friction emerged over a U.S. letter outlining steps China must take on fentanyl. Beijing found it intrusive, especially the demand to publish compliance in Communist Party media, but negotiations are nonetheless moving forward. Let me hit the mute button. Sorry about that. My security watch back here is causing trouble with each other. All right. Internally, China has downgraded the talks to meetings, signaling lowered expectations. However, the reality is stark. China's position is weakening while Trump holds leverage, both politically and economically. Analysts now predict a series of small concessions will emerge from these talks, with Trump using each as a symbolic victory to rally markets and public support. In short, the trade war has shifted decisively in Trump's favor, and China is quietly preparing to negotiate under pressure. All right. Okay, got one last article here before we head to the weekend. Comes from LouRockwell.com. Debt spiral, Treasury markets, and a new financial order. This was by Doug Casey of the International Man. All right. Doug Casey, writing for International Man, argues that the U.S. Treasury market is not a stable cornerstone of the global financial system, but a dangerous illusion built on unsustainable debt and political confidence. He likens the system to a king promising a farmer compensation for his seed corn, only to find nothing left when repayment is due. U.S. government bonds, in Casey's view, do not fund productive investment, but consumption, mortgaging future prosperity, and leaving Social Security and similar programs reliant on a bankrupt Ponzi scheme. Casey warns that with interest payments on the federal debt now exceeding defense spending and approaching Social Security levels, the U.S. is nearing a tipping point. He views Treasury yields, particularly the 10-year, as artificial markers of confidence rather than reliable economic indicators. With trillions of unfunded deficits, inflation rising, and debt nearing unpayable levels, he predicts yields will return to 1980s levels when rates approach 20%. He considers long-term bonds toxic, with triple threats: rising in rates, inflation, and potential default. Confidence in U.S. debt is fragile, and political leaders, including Trump, cannot meaningfully control yields without cutting spending, something Casey sees as politically impossible. He also criticizes Trump's credibility and historical ignorance, warning that any policy influence on yields through rhetoric is unsustainable. Should confidence collapse, foreign holders of U.S. debt may unload their treasuries, flooding the U.S. with dollars and causing massive inflation. As the system destabilizes, Casey believes gold and Bitcoin, not government bonds, are safer stores of value. He contends that the foundational role of treasuries in global finances is eroding, and that we are approaching a monetary reset, echoing historical shifts like the 1933 gold confiscation and Nixon's 1971 exit from the gold standard. His final advice: forget investing and think in terms of speculation and defense. Probably not a good idea with all the idiots who are running our government and things right now. So, again, I apologize for the noise. These two want to wrestle back here. So, all right. Well, that is everything that I had to cover for today. So if anyone needs anything from me, please go to, wait for it, DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a ring. I'd be happy to help. All right. Well, hope everyone out there has a great weekend, and I'll talk to everyone again next time. Adios.